Hello and welcome to Portfolio Matters Weekly Markets Checklist, week 168. And it's been a very volatile week in the markets. But before we get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we'll be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics on the show. Full disclaimer can be found at the end. Okay, before we get going, some brief housekeeping. This will be the last Portfolio Matters for a couple of weeks before I go on holiday to Japan. Stuart Owen is joining us today to fill in instead of Richard, and let's get going. Lots of news. So last week saw extraordinary volatility in global financial markets. Last Monday, the Nikkei dropped 12.5%, and that brought its two-day fall to over 20%. That was a crash. However, on Tuesday, it bounced back 9% after the Bank of Japan reassured markets that it would not raise interest rates further while volatility continued. Central banks look after equity markets. VIX spiked, we'll take you through all the data, and global equity markets had a volatile week, though they're now calming down a bit. Crypto also crashed. When market volatility spikes, all correlations tend towards one. Elsewhere, Google has lost its big antitrust case in the US, and that will cause potential disruption to Apple because Google pays Apple $20 billion a year to be its default search engine. So the regulatory environment in the US may be turning against the big tech monopolies. Elsewhere, oil has had a good week on renewed tensions in the Middle East, and we are awaiting Iranian retaliation on Israel following the assassination of the Hamas leader in Tehran. This from Bloomberg summarizes the events last week, and it was a wild week in all financial markets and in Bitcoin. Lots of big price movements. Pause and have a read. So we think that the big cause of last week's volatility was the unwinding of the Japanese yen carry trade, and we have a special section on that coming up. So on the 31st of July, the Bank of Japan unexpectedly raised interest rates by a tiny amount, by 0.15% to 0.25%. But following that, the Nikkei fell 21% in 2 days. And as that trade unwound, so investors who had borrowed in yen to buy overseas assets and tech stocks, amongst other things, sold those tech stocks to buy back the yen they had borrowed. And so there are big falls in global markets. This is Nvidia. And this is the Nasdaq. Sharp falls, though retracing a bit of those falls now. And there is record option buying, particularly in puts. So investors fled to safety. The CNN Fear and Greed Index remains in extreme fear as of yesterday. And after the poor non-farm payrolls print in the US Friday last, markets have started pricing in the possibility of a 50 basis point interest rate cut in the US in September. You'll now see that for the September meeting, it's 50-50 whether they cut to 50 basis points or 25 basis points. Essentially, there's a 100% chance that they're going to cut, according to the markets. And all markets in the world suffered last week during the sell-off, though they're now bouncing back. We'll take you through the data. And finally, according to betting markets, Kamala Harris has surged ahead of Donald Trump in the race to become the next president of the US. And that has big implications for the US fiscal balance, frankly, because the Democrats are likely to try and raise taxes to bring the fiscal deficit under control, whereas Donald Trump had promised to keep those tax cuts that he instigated in 2016. Okay, now quickly, a piece on last week's sell-off before we get into the macro data.
Yeah, so last week was quite extraordinary price moves across so many financial assets. It can be tricky, of course, to identify exactly what caused this. It's a bit like saying what caused an avalanche, which snowflake was it that tipped the system over? But it does appear to have been the unwinding of massive carry trades in the yen that precipitated this. So the BOJ hadn't been totally clear about when they were going to raise interest rates, but they did by, as Keith said, just 0.15%. So this caused some rise in the yen, which combined with seemingly weak data from the US implied that the gap between Japanese and US interest rates was going to narrow more quickly than had been expected. So that might not actually be true. The US economy is not doing so very badly, but that was enough to cause all these big flows in financial markets. So equity markets were hit badly, in particular the Japanese equity market. We can see that here. As Keith said, down over 20% at its worst, but then it bounced right back. And that reflected itself across other markets, including in the US and in particular the tech stocks. Bonds, as you might have expected, rallied, though not quite as much as I would have thought, given the extreme moves in equities. So bonds rallied, i.e. yields fell, but then that unwound as well. So to be honest, I was surprised that this avalanche didn't cascade and become even worse. The fact that it bounced back quite quickly was a surprise to me, because I thought the degree of leverage was so large that this could have caused a very protracted avalanche, cascading for longer and longer. But it didn't play out like that. Within a week, we were back, almost to where we started. So the VIX index here, this is a measure of options volatility. It's a great shorthand for what's going on in markets. That had been quiescent for a couple of years, and we often pointed that out on Portfolio Matters. But then it zoomed to absolutely extraordinary levels, from in the teens to 65. Now that makes a massive difference to everyone who uses volatility in their risk models, and therefore affects their positioning in markets and caused a massive unwind of every position, not just in a yen carry trade, but across a whole portfolio. And this is quite an extraordinary move. I think the volatility of volatility reached a record high.
Yeah. The background to all this, as we've been saying relentlessly and wrongly for weeks and weeks, was that markets seemed just extraordinarily complacent. The market was going up with very little volatility. VIX was really low. Valuations were stretched and interest rates were high. And, when you looked at the fundamentals, it seemed that equity markets were getting well ahead of their fundamentals, but just relentlessly going up. And so on this podcast, we've been deeply skeptical about the equity valuations, and we'd been wrong, but we were right to stay out.
Well, I did actually have a little play trade in the VIX earlier this year, where I did a spread bet on VIX because I couldn't believe it when it was down at 11 or 12.
Yeah.
And volatility did rise a bit, but every time I checked it, I was losing so much on the broker's financing charges that I just had to close it. It was only a play trade anyhow. Of
Yeah.
course, if I could have kept it running, I would have made a very nice profit. But that's the point with spread betting. The financing costs
Yeah.
eat into your return.
Well, the thing, I did a podcast on the iPath VIX ETN, which was a disastrous small investment of mine. And these are VIX ETNs where you try and buy volatility when it's low. And the idea is that, and if VIX spikes, you get paid out, which protects you against losses elsewhere in your portfolio. That's the idea. But the reality is the contango in the futures curve for VIX is awful. And every day you hold it, you lose money. So you lose about 20% a week. So you can't hold it for any period of time. I'll try and include a link to that particular video in the description this week. But you can't hold VIX ETNs as protection for more than a couple of days, basically. They're a terrible investment.
Right. Having zoomed up, VIX promptly retraced half or 2/3 even of its peak, ending at about 20.6%. And as I say, I've been surprised at how well this adjustment has played out. I really
Yeah.
think we could have had a very big cascade across so many different positions, but it hasn't worked out like that. People's risk models, despite being highly similar to each other, appear to have been effective. I thought it would have caused an absolute crowding and an impossible exit.
Well, if we look at the history of VIX, I would say you tend to get clusters. It is very rare for you to get just VIX spiking and then coming back down to 20 and then going back to where it was. You tend to get periods of higher volatility. And I would expect more volatility to come. Like you, I've been very surprised by how quickly markets have returned to their previous quiescent, steadily grinding higher state, as though, this is a one-off that can be ignored. But what normally happens when VIX spikes is that feeds through into VAR models, so the value at risk models used by investment banks, and markets have become riskier. Therefore, the VAR models reflect that and mean that investment banks, hedge funds have to start reducing positions. And you would expect there to be a global risk off move in the coming weeks.
Well, I'm surprised that it hasn't happened already. I thought these models would require trades in the very short term,
Yeah.
rather than over weeks. I thought it would be over days.
Well, JP Morgan are reporting that, well, have estimated that 75% of the $4 trillion yen carry trade has been unwound, which seems extraordinary.
Mm.
I would be very skeptical you can unwind it that quickly in a falling market.
Well, yeah, me too. Me too. And I really thought that would cascade into many other positions. As you
Yeah.
said, these value at risk models, they apply across a whole portfolio and rely on correlations between different positions. I would have thought that would have required the unwinding of any trade which had done well recently, not just
Yeah.
the carry trade. So the one-day rise in the VIX was the second largest ever recorded. So here we go. This is the volatility of volatility,
Yeah.
second highest ever. So bottom line, the last week's sell-off appears to have been precipitated by weak weak US non-farm payrolls, which led people to expect a US interest rate cut, combined on the opposite side with the BOJ unexpectedly increasing rates, and therefore the gap between US and Japanese rates narrowing more quickly than expected. However, the shock appears to have dissipated quite quickly. And in terms of fundamentals, there seems to be some gentle sign of US economic weakening, but not entering a recession yet. So the outlook from here, as much as one can guesstimate it, well, high volatility does matter. Market positioning was very stretched. The momentum seemed to be very high, and that would lead to big unwinding of positions. Not just, as we keep saying, not just at the yen carry trade, but across everything. And given how financialized the US economy is, you could expect that to lead to loss of consumer confidence and consumer spending. So, as ever, expect more volatility. We doubt that we're out of the woods yet.
Well, I will take you through some of the data this week, but the thing is, the US economy is very highly financialized. And if nothing else, this has shaken confidence in a relentless bull market in AI stocks, etc. And holders of Nvidia and some of the more speculative AI stocks have taken a big hit. And anyone who bought in, in the latter stages of the bull market will have lost money. All of that feeds through to falling wealth and confidence. So we'll see if they could bounce back, but it is difficult to reinflate a bubble, I would say.
Well, that's what I thought in 2022 when markets were rebasing themselves, and
Yeah.
we did get a second wind of the tech bubble. I have to say also that it's not clear to me that people's confidence would have been shaken, because you could argue that a buy the dip mentality this week
Mm.
worked,
Yeah. No,
given
that's
that
true.
given that
But
so many people's investments are based around, for instance, an S&P 500 index fund. The flows into that will proportionally just nudge up every stock. It'll
mm,
there's a
well,
risk that this might reinforce people's belief that equities only ever go up.
the thing is, Stuart, at the index level, I think that's true. But if you look at the big AI company stocks, they haven't had a huge bounce.
Yeah,
So
yeah.
we'll see. I'll take you through the data in due course. Okay, on to this week's economic data, and starting with the UK. Well, big numbers out this morning. So the UK economy seems to be doing much better than I or the IMF had expected. Reminder, the IMF was forecasting that UK GDP growth would be just 0.6% in 2024, and already in the first 5 months of the year have had growth of 1.4%. So in June, unemployment was expected to rise to 4.5% from 4.4% in May. Instead, it fell quite sharply to 4.2%. Now, let me read this out. This is commentary from the ONS. So, this is commentary from Trading Economics this morning. The United Kingdom's unemployment rate fell to 4.2% from April to June 2024, down from a 2.5-year high of 4.4% and below market forecasts of 4.5%. The number of unemployed individuals decreased by 51,000 to a total of 1.44 million, driven by declines in those unemployed for up to 6 months, bringing the figure below last year's level. Additionally, the number of individuals unemployed for over 6 months, up to 12 months, as well as those unemployed for over 12 months, also declined, but remained above last year's estimates. Meanwhile, the number of employed individuals increased by 97,000 to 33.1 million, mainly due to a rise in part-time employees and self-employed workers, partially offset by a decrease in full-time employees. The number of people in employment with second jobs also rose during the period, accounting for 3.8% of employed individuals, i.e., the overall unemployment rate is pretty much unchanged from last year. And overall employment continues to grow. There's very little sign of a big slowdown in the UK economy, which is doing just fine despite interest rates that are very high by the standards of the past decade. The UK economy has proved surprisingly resilient, which is very bad for my bet that the sharp rise in interest rates would cause a recession. It hasn't done so. Now, moving on to earnings growth, including bonuses, there was a sharp drop to 4.5% in June, down from 5.7% in May. That met expectations. However, if you look at earnings growth excluding bonuses, there was only a small drop in earnings growth in June to 5.4% from 5.8% in May. And the cause of that was that last year, the government gave NHS workers a one-off bonus that has not been repeated. So when you look at earnings growth Inc. bonuses, including bonuses, there's a sharp drop in earnings growth. If you exclude the bonuses, earnings growth is slowing much more slowly, and that is bad for the fight against inflation. Now, according to Trading Economics, consensus expectations were for earnings growth excluding bonuses to slow to 4.6%. And so the actual June number is well above that. But bond markets have reacted calmly to the number, and the FT was reporting that the Reuters consensus, the consensus figure reported by Reuters was 5.4%, not 4.6%, in which case the June number came in on expectations. And the reaction of the bond market seemed to suggest that the Reuters figure is the correct one. Now, I have downloaded the weekly earnings data from the ONS, and the table bottom right shows you the annualized rate of increase based on the monthly numbers. So if you're to annualize the 1 month change in pay, you get 3.8% for regular pay, 3.5% for total pay. And overall, there does appear to be a bit of a slowing. Now, the way you reconcile the previous chart with this data is I've taken the 1 month change. The previous tables charts used the annual change in the 3 month average. Now, when you look at public sector pay versus private sector pay, you can see that last June there was a sharp jump because of the one-off payments, and this year there's a corresponding one-off dip. In June, the UK economy created 97,000 jobs, and that was massively better than market expectations. The market was expecting it to lose 35,000 jobs. So in June, evidence that the UK economy was strengthening. But we have July numbers for the claimant count, and they shot higher. So having strengthened in June, was there a slowdown in the UK in July? Difficult to know. Let's wait to see what happens to the data, but that is quite a big jump in the unemployment figures for July.
That is slightly worrying, isn't it? Because you would believe that the claimant count is a harder number than the employment figures, given all the problems the ONS has in assessing the employment situation. Whereas claimant count, well, that's a tougher statistic to fiddle. That's unemployment benefit being paid.
Yeah, and you'll see when you look at the trend over the last year, I mean, there's been nothing. And then the
Boom.
last 3 months, there has been quite a large increase. So contradictory data. Now, if we turn to the highly unreliable HMRC payrolls data for July again, you'll see that decent number in July. So contradictory data. According to in June, the unemployment rate fell, but then in July, we had a big surge in the claimant count. Let's see what happens when we get July unemployment data. If the claimant count data is correct, then you'd expect to see unemployment rising back again in July. Overall, if you look at total number of employees in the UK, it is continuing to rise. There is no sign of a recession and job losses. So this is the annual growth in the number of payrolls, and it shows that the labour force is still growing. Its rate of growth has slowed sharply post-pandemic, but that is still a decent number, frankly. Moving on to house prices, well, in July, Halifax reported a 0.8% rise in the price of houses that it was writing mortgages on, which is a big jump after 4 months of zero or negative growth. And that brings annual house prices, according to Halifax, up 2.3% over the past year. The British Retail Consortium Retail Sales Monitor for July came in on target, with sales bouncing back from the loss in June to plus 0.3% month on month. We had the construction PMIs, and that was unexpectedly strong, actually. So it came in at 55.3, up on June, well above expectations. And it seems that despite high interest rates, the UK construction sector has bottomed. The Citigroup Economic Surprise Index remains positive. It's faded a bit, but still strong. Job postings have flattened, and that's a month or so now, with no further falls in job postings. So all the data seems to suggest the UK economy is resilient and not deteriorating. So when you look at the gross GDP numbers, actually not too bad. The UK is doing okay. Now, we've talked previously about the PSBR and how there has been a step change post-pandemic in the level of the public sector borrowing requirement. Now, one thing that is causing that is QT, is the losses on the Bank of England's bond portfolio. Now, prior to the pandemic, the Bank of England was making QE profits, which it was passing on to the Treasury, and that flattered the PSBR, whereas now the Treasury is having to send money to the Bank of England to pay for QT losses, and that is making the PSBR worse. So when we show you the chart of the PSBR, bear that in mind. The actual decrease in the PSBR caused by spending, real spending, is less than the chart suggests. Now, there has been quite a lot of talk about what Rachel Reeves will do to balance the books. And one thing she could do is to change the way the Bank of England accounts for its QT losses. If she changes the rule to target net debt, then she gets an extra 16 billion of headroom. So let's see what she does. It seems a quick political fix, but the net effect would be to allow more borrowing, and the UK public sector net, and the UK's debt is currently around 100% of GDP, and we need to get it down. So UK summary. UK is proving remarkably resilient to the rise in interest rates. Wage growth continues to be high. I had forecast that the rapid rise in interest rates combined with the high levels of debt in this country would lead to a recession. It just hasn't happened. And all the data suggests that the UK economy is resilient and there's no sign of it slowing. Wage growth remains too high, so inflation will take time to come down. On to the EU, Stuart.
Well, here I think we're just to prefigure. I don't think the picture is quite so happy. So, for example, European retail sales month on month, against expectations of a small decline of 0.1%, they came in at minus 0.3%. Converting that to year on year, basically just a very small fall, minus 0.3% year over year. But I think if you look at that chart, you can see pre-pandemic small positive numbers and now basically small negative numbers for about 18 months or so. Not good. European construction PMI, a similarly depressing picture, coming in at 41.4. And that is not an exceptional number in the context of the past couple of years. Nothing going on.
Yeah, and when you contrast the UK 55.3, construction bouncing back, European construction 41.4,
Yeah,
and that is
horrible.
close to its lows of this cycle,
Yeah.
not improving.
And that's reflected in the economic surprise index, which is much worse than the UK, coming in at minus 50 on this scale. But the point is it's below zero.
Yeah.
And reflecting that, German Indeed jobs postings continue to come off, being weak since the beginning of 2023. And France, maybe some bounce there, but I think you'd have to say the bigger picture over the past couple of years is weakness. Right, now here's a somewhat depressing scatter plot showing the old issue of debt in the European Union. On the x-axis, there's government debt as a percent of GDP. The y-axis is budget deficits, again, percent of GDP. And there we have the bottom right, in the naughty corner is Italy, with very big debts and very big deficits. I think we've mentioned before that Italy actually runs a primary budget surplus. They're trying to do the right thing, but the burden of the historic debt is such that their overall budget deficit is still heavily negative.
Yeah.
So the problem here is the tensions within the Eurozone. You've got some countries trying to obey the Maastricht rules in terms of debt levels and deficits, and others that in effect have got away with it over a number of years. So it's not particularly in the headlines at the moment, but all the ingredients remain for another Euro crisis.
Yes, absolutely. At some stage, this is unsustainable. Italy can't continue to run a huge budget deficit with 140% of GDP. At some stage, those debts become unpayable. But markets currently are not concerned.
Not a problem until it is a problem, and then it's a problem. Right, continuing Keith's series of looking at actual nominal GDP levels, here's France, which you can see creeping up, perhaps not as strongly as the UK recently.
Yeah, but I mean, my point about all these charts on actually Eurozone economies is that when you look at their performance since the GFC, really not good.
Germany a bit better.
Yep.
Italy, oh, there's the classic case, isn't it?
Yep.
Big falls after the GFC, picking up a bit. I see these are presented in US dollars. Are they in sort of PP US dollars? Do you know?
Sorry, in what, sorry?
In PPP US dollars.
No, just in US dollars. This is just in US dollars.
So at prevailing exchange rates.
Yes, that's right.
Right.
Yeah, no, that is true.
But still, the difference between the countries is stark, with Germany doing okay, France not, and Italy particularly poor.
So we know that recently, Italy, Spain, and Spain in particular have been driving Eurozone growth. But the point is that actually they're just recovering from very poor performance since the great financial crisis.
Yep. And yes, well, there you have the spending numbers illustrating exactly that point. Some pickup over the past couple of years after a
Mm,
period of 7 or 8 years of real contraction. Greece, well, I think you've pointed this out in previous weeklies, but look at the magnitudes here. From after the GFC, the economy
yeah,
shrinking from what, about 350 billion to about 195. Massive. I mean, that's a depression.
that's a depression. It's unbelievable um, how committed the Greeks have been to the Eurozone. I mean, that a fall of a third in GDP. The Great Depression in the US lasted for 3 or 4 years. To put up with 15 years
Yeah.
of fall of 30% of GDP, harsh. But now the Greek economy is recovering as Greek wages have finally come back to more competitive levels. And that is the fundamental problem of the Eurozone. If you don't have a flexible exchange rate, then the competitiveness of the economy has to adjust via the real economy, via real falls in wages or wages stagnating for 15 years while everyone else's wages race ahead. So your relative wages improve or fall to make you more competitive.
So the EU, in summary, retail sales in June were weak, down 0.3% month on month. And in the construction sector, the PMI fell even further to 41.4, but basically, flatlining at best, possibly shrinking in the Eurozone.
Yeah. Okay, on to the US. So the big number was Friday last, we had non-farm payrolls, and that came in unexpectedly weak at 114,000 jobs created in July, well below expectations and down on June. And the June number was revised downwards as per usual. Private sector payrolls were particularly weak, coming in at 97,000, still jobs created, but much lower than June or expectations. Government payrolls also fell. So does that mean that after propping up the jobs market for the whole of the last couple of years, government payrolls, government jobs growth is now starting to slow? Now, if you look at the jobs growth sector by sector, you'll see the construction industry, surprisingly, is still creating jobs, and the jobs growth remains broad-based. Information technology is the only one to really start to be shedding jobs. 10 of the last 14 non-farm payroll reports have been revised lower. So the July number could yet be revised even lower than it is now. Now, the construction payrolls continue to climb, which is amazing given the rise in interest rates, and we would expect that to slow the housing market, leading to lower construction and job losses. That just hasn't happened. But falls in the number of housing units under construction mean that there are now, because the number of employees continues to rise, there are now more employees per project. How long can that last? We've been saying this for a while, but the fall in housing starts does not seem to have led to job losses. And Parker Ross has done some modeling, and he expects construction industry employment to slow from here, but not to go negative. So no sign of falls in construction sector jobs, and that is normally what instigates a recession. And reminder, this is against a backdrop of US housing affordability, which is its worst in 30 years. Now, part of the rise in unemployment in July was undoubtedly weather related. So when you look at the number of workers who were out of work on part-time work due to bad weather, it spiked in July, in part as a result of Hurricane Beryl. However, when you look at the state-by-state data, temporary layoffs in Texas actually declined in July, suggesting it wasn't Hurricane Beryl. Most of the temporary layoffs were in California, perhaps hot weather or something. Now, if you exclude temporary layoffs, then the rise in the unemployment rate reported in July looks much more gradual. And since June 2023, if you look at the labor force survey, the US economy has lost 1.1 million full-time jobs. All the jobs growth has been part-time. Reminder, non-farm payrolls counts multiple job holders multiple times. Non-farm payrolls, the establishment survey, continues to show the US economy creating jobs in a very steady fashion, despite the miss in expectations in July. It still created over 100,000 new jobs, whereas the household survey shows a much more pessimistic portrait of the US jobs market, and it reports that job creation peaked over a year ago. I found this very interesting. When you look at who's losing their job, it's people on higher incomes. And going back to the chart we showed earlier about which sectors are losing jobs, the few that are, it's information. And so during the long period of zero interest rates, you had a lot of startups and a lot of tech startups. I wonder whether many of those are now going bust, leading to job losses in the tech sector. And the unemployment rate is low, but is rising in a manner that is typical of recession, and the SARM rule has been triggered. Moving on to weekly earnings. Well, good news on inflation. Weekly earnings came in at only 0.2% month on month, below expectations, down on June, 3.6% in July, down on June, and the June number was revised downwards. Inflation, wage growth in the US is slowing, and that is good news for inflation. Weekly hours worked also dropped. So generally, the data show that the US jobs market is slowing, but slowing slowly, and there is no sign of a recession. It's just growth is slowing. So the fall in hours worked means that weekly earnings have risen less than hourly earnings. And the participation rate ticked up in July. That's good news. The unemployment rate rose to 4.3%, well above expectations and above June. So the SARM rule has been triggered. Now, reminder, we don't think the SARM rule is as reliable this time because a lot of the increase in unemployment has come from new entrants to the jobs market as opposed to layoffs. But unemployment is up 21% year on year, and that is something you normally only see during a recession. You can see here that the unemployment rate for new immigrants has been rising and is now at around 12%. So new immigrants are finding it increasingly hard to find jobs. And the blue section of the bar is new entrants to the labour force as a percentage of, and how much they have contributed to the rise in unemployment. And you see that unemployment has risen by about 0.8% year on year, and 0.21% of that has been new entrants to the jobs market. So about 25% of the rise in unemployment has been to people entering the workforce. Having said all that, permanent job losers are the largest contributor to the rise in unemployment. So unemployment is rising due to layoffs, but rising very slowly. And the U6 unemployment rate, which includes discouraged workers, jumped to 7.8% in July. Factory orders in June were poor, down 3.5% month on month, below expectations, and well down on May. Now, we also had the ISM services PMIs, and they were reassuring. So following the poor non-farm payrolls, that reassured the markets that the US economy was not heading for an imminent recession. So in July, services PMI strengthened to 51.4, which is still not a strong number, but up on June and above expectations. Business activity much better at 54.5, well up on June and above expectations. Employment bounced back above 50, well above June and well above expectations. Expectations had been for it to be below 50 and therefore falling. New orders bounced back to 52.4, above expectations, well up on June and again expanding. Prices paid, though, rose to 57. Not good news. Exports continue to grow, though not as strongly as expected. Imports slightly missed expectations, but also continue to grow. No signs of a slowdown in the US economy from the trade data. The RCM TIPP Economic Optimism Index, which is a survey of consumers, show them still remaining pretty pessimistic, frankly. Consumer credit is weak, but not declining further. Inflation expectations remain flat at around 3%, and that is around the pre-pandemic average. The Logistics Managers Index, having fallen sharply at the last year, has bounced right back. So goods and services being moved around the country, that looks okay. Johnson Redbook retail sales, 5.1, good number. Initial jobless claims fell back last week, so there's no sign of a surge in jobless claims. But continuing jobless claims do continue to climb, and that was higher than expectations. So compared to the pre-COVID average, unemployment is rising, but slowly. There is no sign of an acceleration in unemployment that would mean an imminent recession. Turning to the nowcast data, Dallas Fed is at 2%. Atlanta Fed, which always seems to be a bit high, was at 2.9%. That's up.
Sorry to interrupt, but are these forecasts for the overall US economy, or are they for the regions that those Feds cover?
No, they're for the overall US economy. The New York Fed nowcast strengthened to 2.24%. St. Louis Fed 1.6%, up sharply. So all the nowcast data suggests the US economy is doing just fine, thank you very much. Though the economic surprise index is at -34. So the US economy is not as strong as economists had been expecting. The Indeed job postings index has bottomed for now. Trueflation shows very little inflation. And credit card data shows that consumers are still spending, but growth is slowing. The US consumer is maxed out. Now, turning to the national debt, the current US national debt is $35 trillion. That is 105,000 per person, 267,000 per household, 484,000 per child. So we need the US to exercise some fiscal responsibility, and one of the prime reasons that I'm very keen the Democrats get in, frankly, is they have a plan for controlling the debt.
Keith, of course, you get similar horrific numbers in Japan. Europe, not very good either. I mean,
Yeah,
it's a real systemic problem of welfare states and how much debt
yeah.
run up.
Well, this is, fundamentally, Stuart, I just don't think you can have positive real interest rates with these levels of debt. And that may mean financial repression
Mm.
to yield curve control to get rates down. But unless you get strong positive economic growth, which, everywhere outside the US, the developed economies like the UK have really struggled with post GFC, then positive real interest rates plus the existing debt and fiscal deficits means the debt's just going to keep on growing. So
It's deeply scary.
it is.
As a little side note, I noticed that the US tips broadly yield 2% real, which
Yeah,
seems like a pretty attractive offer to me.
absolutely. I completely agree with you. Um, okay, so US summary, pause and take a look, but I hope you've got a picture of the US economy where the labor market is slowing, but it's still creating jobs, and jobs growth is slowing, but there's no sign of the acceleration that would normally indicate an imminent recession. Nowcast data shows the US doing just fine. On to China, Stuart.
Right. So we got the Caixin manufacturing PMI here. Expectations were 51.5, but it came in under 50 at 49.8. So confirming the impression of lukewarm slowing activity in China. Services was a bit better at 52.1, better than expectations, better than June. The composite, however, weighed down by manufacturing, came in weak, 51.2. Inflation month on month came in at 0.5% against expectations of 0.3. If I had to have guessed, I would have thought it would have been weak, but perhaps numbers bounce around a fair bit month to month. Inflation year on year, 0.5%. And no
Yeah.
wonder people are buying Chinese bonds.
Yes.
PPI year on year, also negative, minus 0.8%. I think this is part of a broader picture of post-COVID conservatism, worry, financial concerns leading to a sort of slightly deflationary atmosphere in China.
Mm. Well, also, if you invest loads in, manufacturing capacity, then ultimately you produce a load of goods. If there's no demand, prices are going to fall.
Yes, well, I was listening to a podcast about the EV market in China.
Mm.
Guy had a very good phrase. He said, look, China isn't interested in profit, it's interested in GDP, because it's
Yes.
interested in employment. And hence, they're quite happy to subsidize activity if it subsidizes employment.
Mm.
China balance of trade, of course, big surplus here. Expectations were for a very large surplus of 97 billion, came in at just 85 billion for the month.
Yeah, still, we
Massive.
would envy that.
I don't think since the Industrial Revolution have we had
Yeah.
any sort of balance of trade like that. However, the current account balance, this picture surprised me. Positive, but not half as strong as I thought it would be.
Mm.
Exports year on year up 7%. Expectations had been for closer to 10% growth, but I think that the basic picture here is, as we know, China is trying to export to support its economy and to support employment. Imports are up 7.2%. So rising imports is not, as it would be if you were Donald Trump, a bad sign. In a sense, it's a good sign for China. They import so they can process and re-export.
Mm.
Vehicle sales year on year down 5.2%, however. So again, some evidence of domestic consumption conservatism in China.
Yeah.
China 10-year yield. This has been a funny story to follow over the past few months, where the Chinese government is criticizing, naming and shaming institutions and people who buy their bonds.
Yes.
It has led to far too low an interest rate, and the implication being the economy is doing poorly.
Yeah, I should say that this it's bounced since here, actually.
So in summary, for China, Caixin services came in better than expected, but manufacturing was weaker. Some positive signs on inflation month on month, but in general, to me, it looks like the Chinese economy domestically is rather weak, and they are frantically exporting to support GDP and employment.
Yes, absolutely. And that's exactly what you expect when a property bubble bursts.
Yeah.
And everyone who's bought all these unoccupied single flats as investment finds their prices falling. Okay, on to one chart. Thank you, Stuart. Now this is the US real prime rate. And so it's the rate at which banks lend. So higher than the Fed funds rate. And this is the real prime rate. And it's the highest level in actually since the GFC. In fact, maybe even above that. So interest rates are biting in the US, and they particularly affect small businesses. As we enter, hopefully, an interest rate cutting cycle, that should be very good for US small businesses. And frankly, look, right now, it looks to me like the US has achieved a soft landing because they have a lot of monetary space. So they can respond to any weakness in the US economy by cutting rates, which will be good for US small businesses. So having been calling for a recession for the last 18 months, frankly, it just doesn't really look like it's happening and that it looks like the US money, and it looks like the Fed has the ability to cut rates and keep the economy going. Stuart, any thoughts?
I was quite surprised to see the number being as high as this. It must be awful being a small business in the US at the moment. You're absolutely squeezed on your financing, and probably also squeezed by some giant corporation. Yeah, very tough environment. Having said that, it's not quite the same to look at small companies on the stock market as small businesses in the economy. But I'm coming across more and more references to some very attractive investment opportunities in US small cap, in the sense that these companies have been neglected as all money flows go into the S&P 500. And in the small and micro cap, various managers commenting on what tremendous investment opportunities there are.
Really?
If you look at traditional metrics, PE ratios, balance sheet situation, and cash flow return on investment. Now, if one was able to buy a whole basket of these things and sit there and just pick up the growth in the fundamental business value, is actually quite an attractive opportunity. So I had a little look around, but I can't find any investment trust or ETF that actually represents this. It's much more of a stock picking idea, and you've got to pick a manager who's actually prepared to sit with that as an investment strategy. And that, of course, is the difficulty, because everyone has been drawn into tech and momentum ideas.
And on to Simon's technical analysis. So we did this last time, and obviously there's been a hell of a lot going on in the market. So positive feedback, and Simon has kindly offered to do this quite regularly. So he has updated his analysis of the S&P 500 and the Nasdaq. So this is the S&P 500. He was previously expecting a 6% correction, and that appears to have happened. He now expects the S&P 500 to consolidate above 5,300 and does not expect a bear market, though beware of the usual September-October seasonality, he says. The worst case scenario, he expects the S&P 500 to head down towards the yellow line here. So that would be bad. So he's saying limited market upside for now. For the Nasdaq, pause, have a read. The bottom line is he's saying the market has definitely topped for now. And he's saying don't hold QQQ or SPY, i.e. either the Nasdaq or the S&P 500. And overall, the US markets are a sell in his opinion. He expects seasonal weakness going into September, October. And you see, his analysis involves these big wave moves. So we've had a wave upwards. He now expects a wave downwards before the market recovers. Simon has played this market very well over the last 18 months. So worth taking notice of. And on to the yen carry trade, Stuart.
Right, so this has been a big focus this week, given the impact it's had on markets. But just to take a step back and try to explain what's been going on here and how carry trades work. So this is the yen carry trade. So the idea is that you borrow money in yen, which historically you've been able to do at basically 0% interest rate. So you've got a whole load of money in yen. You then flip that into the currency of another country where interest rates are higher. So for instance, Australia, about 4.4%, the US, 5.3%, or Mexico, almost 11%. So you're paying 0 and you're earning 4, 5, or even 11%. Sounds good. Economic theory would suggest that that difference in the interest rate will be reflected in a change in the currency exchange rate, offsetting your interest rate gain. Doesn't work out like that in practice, though, because everyone's interested in making this trade profitable. So in fact, quite often, instead of losing on the exchange rate, you often win on the exchange rate because of the volume of money copying this trade is so large. So, for example, the Mexican peso divided by the Japanese yen, after COVID, during the COVID pandemic, this was about 4.5, and it went up to 9. So not only did you earn Mexican interest rates compared to paying 0 rates in Japan, you doubled your money on the exchange rate change as well. Now, this pattern is quite interesting. Often people who look at carry trades talk about a sawtooth pattern, where you win, you win, you win, you win, you win, you lose big. So the key, of course, is to get out before that big loss.
Yes. And
highlighting the potential profitability of this trade is quite extraordinary, but John Author's chart here shows that the Bloomberg Peso Yen Carry Trade Index outperformed the S&P 500 total return since 2020. I mean, quite remarkable. So what are the risks in doing a carry trade? Well, the Japanese might increase interest rates. You're borrowing, hoping to pay 0, but of course, Japan might increase interest rates. And they did that by a whopping 15 basis points up to 25 basis points on the 31st of July. The other side of the trade, you could also lose on. The yield on your investment could go down. And For example, on the 8th of August, the Bank of Mexico cut its interest rate by 25 basis points to 10.75. Those, I think, are relatively modest. The big risk to a carry trade is your currency mismatch. So if the yen appreciated against the currency in which you were investing, for instance, the Mexican peso, then that would massively impact your profitability. So to work that through as an example, if you borrowed 1 billion yen, paying a 1% interest rate, you could convert that in step 2 to 6.9 million American dollars, and you could invest those 6.9 million American dollars in US dollar low-risk assets earning 5%. So the result of that would be you'd be making about $276,000 per year if exchange rates didn't change. However, what happens overall if the yen suddenly appreciated by 10%? Well, after all, you've borrowed 1 billion yen, and so you have $6.9 million of US dollar assets, but now that only buys you 900 million yen if you were to do the foreign exchange the other way around. So to repay the 1 billion yen, you now need 7.7 billion. So you previously had a nice steady earning profit, but suddenly you've got a big capital loss. So you've now lost 800 grand on the value of your US dollar assets when re-expressed in yen, though you have made a few hundred grand in interest payments. Other ways that you can lose in a carry trade, well, the value of your investment can fall. If you're investing in some short-term US bonds at 5%, that's pretty unlikely. But a lot of people seem to have been investing their converted yen into US tech shares, much, much more volatile, of course. And often this trade is done in a very leveraged way as well. So the losses on the trade can imply a very big loss to your equity because you've geared it up. Now, this seems quite likely if everyone decides to rush out of the trade at the same time, and therefore there's a complete panic, which you sort of saw last week when the currency fell so sharply as everyone was trying to settle up their positions. So here's a chart showing Japanese interest rates and why the carry trade became so popular. In the 70s and 80s and 90s, you were having interest rates which were vaguely sort of normal, between 3 and 9%. But since 1998, interest rates have been at or close to zero, even negative for a few years. So this looks like the perfect currency to borrow because you've got very, very little to repay in terms of annual interest. Interest rates have been increased, but it's at a minuscule level. We've gone from slightly negative to plus 0.25%. So as the carry trade unwound over the past week, investors repatriated their assets. So they were forced to buy yen to repay what they had borrowed. So you get this very sudden appreciation of the yen, which went from over 160 to the dollar to under 150. We first explained the carry trade in terms of borrowing yen and investing in relatively safe assets like US T-bills or possibly even Mexican T-bills. But of course, as a trade becomes successful, people begin to push it. And what has become a carry trade, or what started as a carry trade across bonds, can morph itself into a carry trade in other assets. And we seem to have seen that with people using the yen that they've sold to buy dollars to further buy, for instance, tech stocks. There's been a pretty clear correlation between the sell-off in the yen and then the rebound in the yen. That's been correlated with the performance of the Nasdaq 100. So there's various layers of risk here. There's interest rate risk, there's foreign exchange risk, and then you've got asset class risk. However, I can totally see how momentum-based models, which might be driving some of these positions, can lead people to think that all these trades are going to compound up on one another in a positive way. But of course, that can all go into reverse and tends to do so at the the time of maximum extension of the trade, when everyone's been doing it, no one else is left to add to the momentum. So many investors had borrowed yen to invest, as we say, in the Nasdaq. And one way of looking at that is the correlation between the yen's movement and various equity indices. We can see very high correlation with the US semiconductor index, 78.4% correlation, which is even higher than the correlation with the Topics index, and certainly higher than the correlation with the World ex-US index.
So what this is saying is that the yen carry trade has been a key driver of global markets over the last couple of years.
I see them all as reflections of sort of momentum trades. The yen
Yeah.
is going down, people sell the yen. Nasdaq is going up, people buy that. You put the two together, add some leverage, and you've got a momentum engine. Now, a different aspect of this, I think slightly different from a trading or hedge fund perspective, is the fact that Japanese investors have themselves been looking to diversify internationally, partly because the yen has been weakening and partly for normal sort of prudential diversification reasons. So the net international investment position has gone from about 300 trillion yen in 2018 to almost 500 trillion yen. So I don't think this is quite the same as a trader's carry trade perspective, but in effect, it has the same impact on markets. So we can see a very rapid unwinding here when we look at the nominal exchange rate of Japan against the basket of currencies. We see it weakening and weakening and weakening from 2020 and suddenly snapping back over the past week or so. Having said that, it's still pretty weak.
Yeah.
The yen on a sort of purchasing power basis is still a very weak, attractive currency.
Yeah. So I'm going on holiday to Japan next week, and I wish I'd locked in my yen last month, but still, Japan looks cheap. Yeah.
Does indeed. Yeah. And the other thing to say, Keith, is that when you buy your sushi for $10, there's no tip involved either. So you haven't got to pay the American 20, 25, 30% tipping on top.
Yeah.
Now, trying to estimate how much carry trade there is out there is actually quite difficult. But one way of looking at it is the CME, that's the Chicago Mercantile Exchange, net yen short positions. And you can see that in the white bar here. And it appears, difficult to say, but possibly a bit more than half unwound on this measure.
Yeah.
Now, this chart, I'm not quite sure how it's produced, but suggests that traders have switched from net short to net long in the yen in record time, hence the very sharp appreciation over the past week.
Yeah. Again, so CFTC positioning net is only part of the part of the picture, because you've got options positions, etc.
Yeah, right. Now here we're also looking at another, in effect, source of carry, and that is the BOJ, which has been printing and issuing yen at a zero cost, and its balance sheet has been invested across many, many different assets. Famously, it's invested in its own domestic equity market via ETFs, but it's also been investing abroad. So it, in effect, has a sort of hedge fund position too.
Yes, exactly.
So in a reminder, the Japanese government does run essentially the world's largest hedge fund, possibly rivaled by the Swiss, I would say, but that's a slightly different story. So Japan runs a big budget deficit and has a massive stock of debt. It funds itself with cheap domestic money at interest rates that are kept very suppressed via issuing debt at close to zero.
Yeah. And so it has a big incentive to keep the carry trade going.
Yes, it needs to continue to have very low interest rates to fund its debt, and therefore that will encourage people to borrow at those very low interest rates. Well, bottom line from the yen carry trade. Carry trades have a history of unwinding spectacularly because they are leveraged and they are crowded. I would always urge people to remember this sawtooth pattern. Win, 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 lose big. JP Morgan has estimated that about 75% of a $4 trillion yen carry trade has now been unwound. So although it was painful, in a week that the market seemed to have absorbed it, which I found sort of flabbergasting. Of course, that unwound has led to enormous rises in volatility, not just in exchange rates, but that has carried over into assets bought with that carry trade, for instance, in the AI-related stocks. So we expect more volatility, but I must say I am surprised how much has been absorbed so quickly.
Yeah.
And also, I just want to give a quick plug to our old colleague, Kevin Coldiron. He wrote a whole book about carry trades called The Rise of Carry, which extends this argument all the way into equity markets. So anyone who's interested, that's worth digging out, The Rise of Carry.
Okay, I'm going to apologize to this because it's going to be an incredibly long episode, because actually I want to do the AI section, because I think now that AI stocks have come down, this is increasingly relevant. So we flagged this a couple of weeks ago, and this is taken from primarily a Goldman Sachs report on the future of AI, which had three separate opinions. Now, the economist Darren Acemoglu, he was of the opinion that AI will have a limited effect on the economy and actually will only cause a 0.9% rise in US GDP over the coming decade. Joseph Briggs of Goldman Sachs, he's a salesman. He thinks AI will lead to a rise in US GDP of around 15% over the coming decade, i.e., make a strong and meaningful contribution to US GDP and labor productivity. Finally, this is really interesting. Goldman Sachs' head of research, Jim Covello, took the opposite view to his colleague, saying that current large language models actually have limited ability and will never achieve general intelligence, that AI is overhyped, and because the models are expensive, they will not gain wide acceptance. And so he thinks that AI is overhyped and have limited effect on the economy. Now, turning to Darren Acemoglu's argument, he says only around 20% of tasks in the production process are capable of substitution by AI. And in the coming decade, because AI is expensive, only around 23% of those tasks will be effectively substituted by AI. So using a labor cost saving around 27% produces productivity improvement of only 0.66% over the course of the next decade, leading to a rise of just 0.9% in GDP, i.e. rounding error. His view, AI will improve GDP at the margin, but have very little effect. Bottom line, in his view, AI has limited capabilities, does not have general intelligence, and current large language models do not provide a pathway to it. Joseph Briggs of Goldman Sachs is much more optimistic. He thinks 25% of all work tasks can be improved by AI, and productivity improvements will be driven by a shift of employment into new AI jobs. So that is something Darren Acemoglu ignores. He ignores the fact that new jobs will be created. And Joseph Briggs also points out that AI costs should come down as AI achieves wider adoption. Now, we can dispute that chart later. So if you try and reconcile the view of Darren Acemoglu with Joseph Briggs, you get this chart. And the main differences are that Goldman Sachs, Joseph Briggs, is expecting the costs of AI to come down, leading to wider adoption, and for there to be new jobs. He's also expecting AI adoption to increase sharply in the coming months, and most of the wealth from AI to come from jobs that just simply don't exist currently. And this is the analogy with US economic growth since the 40s. See, most of the jobs growth has been in new industries. So AI adoption has been pretty low, and actually there hasn't been that much increase in the last 9 months. When you look at the sectors that have the highest adoption rates, well, it's kind of stopped growing. So Joseph Briggs is forecasting that will change, that adoption rates will increase. So far, though, there's no indication that AI is displacing jobs. If it was leading to big changes in industry, surely you would expect that. And unemployment has not risen in AI-exposed sectors. Jim Covello's view is that AI is expensive, and most of the problems it's aimed at solving are relatively small and cheap. That is not a good combination. So in order for a new technology to achieve widespread adoption, it must be cheap and easy to implement, use relative to existing solutions. AI is not. Therefore, he's skeptical that AI will be widely adopted. He also points out that large language models don't really have a pathway to cognitive reasoning and replacing human beings in a wide range of applications. He therefore thinks that AI is overhyped and of limited ability. And his experience of using AI in simple summarization tasks is that it often yields illegible and nonsensical results. Now, when Joseph Briggs saying that the costs of AI will come down, well, we've previously shown you this from the Visual Capitalist, and they point out that the cost of training large language models on the latest generation of AI hard software keeps on growing. So it's gone from ChatGPT 4, 7.8 million, to the latest generation would be 192 million. It is not getting cheaper because the cost of hardware in particular keeps on rising. We need more and more hardware. Then AI doesn't get cheaper, it gets more expensive. And so far, observed AI adoption rates have been very disappointing. This is an important chart for AI bulls. And my own view is we've been here before. Whenever a new technology comes along, people get just too excited. It will have an effect, but it will take 20 years for it to be fully adopted and make a decent contribution to GDP growth. And when you look at the big tech companies, they have increased their R&D spending, but the market is not expecting any big change to their sales or earnings. Tech earnings expectations now appear to have topped, which is a problem when their PE ratios have expanded a lot. All of these charts are pre the recent crash, I should say. And earnings growth is expected to slow over the coming years. So PE ratios really high, earnings growth expected to slow. Not a great combination. So this is the latest data and super microcomputer, which we talked about earlier in the year and which makes server racks. Its share price has collapsed and shows little sign of bouncing. So a lot of froth has come out of the AI bubble. And this is my view. This is Amara's law, which we talked about earlier. Innovation investors get hugely excited, expectations get way too high. At some point, the expectations are not met, leading to a collapse. And then over the course of years, the technology proves itself and becomes part of the economy. And if you look at super microcomputer, I think it's got further to go. Now, Meta Labs shows a live example of speculative technology investment. So this is its investments in virtual reality. It's currently lost 50 billion with no sign of profitability anytime soon. So on AI, I think of the three forecasters, Darren Acemoglu, Joseph Briggs, and Jim Covello, I'm very much with Acemoglu and Covello. I think that it's overhyped. Stuart, your thoughts?
Well, my main thought is a little knowledge can be a dangerous thing, and I don't know much.
Yeah,
My prejudice is to be, as with you, to think of the Amara's law, and that we're heading rapidly towards the trough of despondency, but the reality of what these systems can do will lead to changes in the economy over the long term. Having said that, I can't help but think, well, if AI is creating winners, is it creating winners from other people losing? And therefore you get a change in the distribution of profit, but there's very little overall increase to GDP. A couple of other observations. Obviously, AI doesn't just mean large language models. There must be an awful lot else going on.
yes,
And when you think about a large language model, again, I don't know that much about this, but if you're fishing across the internet, across books, etc., a large language model will be useful in subject matters where there is a consensus, where conventional wisdom is accurate and useful. So you could totally see, for instance, in perhaps a medical application, why a nurse with a large language model could be making intelligent decisions that an average doctor could,
yeah,
because the large language model is picking up on the average opinion.
yeah,
But in various other subject matters, it's not going to be useful at all. It'll come up with an answer because a large language model has to. If it's
mm,
sort of probabilistically predicting words based on context, then it'll come up with something, because there's always some level of probability. But there's no real knowledge there.
mm,
So in
yes,
different areas of human knowledge, I mean, ask it to sort of solve the Middle East peace process. It's not going to come up with anything.
yeah.
But in something where it's a more constrained problem, or the knowledge is more established, I could see it being very useful.
Yeah, no, in certain applications, I think it will be very useful.
Yeah.
Your example of the nurse is a really good one.
Yeah,
So
it would
where
sort of cut out the negative element of the distribution in a sense. If average opinion is good and useful, then you could use it to cut out the errors that perhaps a tired doctor would make.
yeah, my only experience of AI though is our startups where we are paying Ukrainian developers to write a lot of software every month. And frankly, I was expecting both the price of my Ukrainian software developers to fall and their productivity to rise, and it ain't happened. So, whether that is something specific to our companies or not, I'm not sure. But so far, software is meant to be one of the big beneficiaries of AI, and I'm not seeing any benefit, frankly, which
Well,
is very
software
disappointing.
employees are seeing the benefit. Yeah.
Yeah. Well, perhaps that's right. They're still writing, 1,000 lines of code. It's taking them 10 minutes in the morning, and then they go to the beach.
I mean,
Anyway,
that is the final point, which you've sort of touched on already. But the Mag 7, in as a generalization, their valuations can be partly justified by the fact that they were making such huge cash flow return on investment.
Yeah.
They were sort of capital light, but that's now changing, that they're becoming a bit more capital heavy because the cost of the chips and the energy
Mm.
is so large that the fundamental sort of golden scenario of a very high cash flow return on investment is beginning to be tarnished.
Yeah. And I mean, Nvidia can still do very well as long as people still, there's an arms race in AI.
Yeah.
But the thing is, we're seeing the equipment companies reporting good revenue. We have yet to see anyone really reporting better revenues or earnings because they're using AI.
Mm.
And that is unsustainable. At some stage, the customers have to start doing well.
Yeah. Mm.
I'll rush through these. So, inflation watch, no new data. The next bank meetings, central bank meetings are in September. So we can relax and go to the beach for a few weeks. Um, Bottom line is inflation seems to be coming down slowly. In the UK, wage growth is too high, and the public sector pay rises announced by the Labour government will mean that wage growth is slow to come down, which means inflation slow to come down, but inflation is coming down. Monetary policy in the UK remains tight, although the UK economy is doing okay. Recession watch. Stuart.
Right. Well, we have here a chart showing acyclical growth in the US, which appears to be slowing. So that's the blue line here, which after having zoomed up after COVID is weakening fairly dramatically. That's
Yeah.
contrasted with cyclical growth, which you would expect would be volatile. But you're hoping, I think, that the acyclical would bail you out. But that appears to be backing off.
Yeah. So I don't know, quite know how they've done that, but that suggests, that what you would expect is given the huge surge of investment during the pandemic, at some stage, all those projects start to be completed. And then that surge fades. Is that what we're seeing?
US government spending year over year is falling. So this is back to a point Keith has made in previous portfolio matters about the size of the deficit would have to be increasing year on year on year for the fiscal impulse to remain supportive of the economy.
Yes.
Even keeping the deficit flat at a large negative number would not stimulate the economy. It would have to get even larger, and that's not
Yes.
happening. Looking at delinquency across different types of borrowing, student loan delinquency has fallen, but I think there's an artifact of a
Mm.
temporary sort of suspension of collecting student loans. More worryingly, credit card delinquency has been increasing pretty steadily. Auto loans topping up a bit. Mortgages not showing any sign of delinquency yet. Presumably, that's the
Mm.
effect of everyone's cheap loans, which they're holding on to. But some signs perhaps here of stress.
Yeah. I mean, 11% is a big number.
Mm. The personal savings rate remains very low in the US, so that sort of safety buffer is fairly emaciated in the US.
Yeah.
People are spending.
Yeah. That's saying that consumers potentially are stretched.
Yeah. The travel boom appears to be over. Some charts here showing falls in hotels, airlines, and cruise line bookings.
Actually, not bookings, but visits to websites. But you expect the two to be
Right.
correlated.
Yeah.
But
Mm. Bankruptcies appear to be rising. I think we looked at this a few months ago, and it seemed to be in the pre-COVID level, but it's now broken out
yes.
above that.
Yeah, absolutely. Previously, it had been rising, but was quite subdued. But now it's kept on rising.
Mm. Delinquency on commercial mortgage-backed securities have surged. I don't think this is really a surprise to anyone, given the difficulties that the property market has had. I think there's been a lot of sort of extend
Yeah.
and pretend,
Yep.
which finally is coming to an end. The yield curve is uninverting. We've spoken before about how the yield curve predicts recession, but the timing is crucial. quite often the market is anticipating the recession, and therefore it's the moment when the yield curve uninverts that
Yes.
is the moment of recession. And that would appear to be about now. So this is not a very encouraging sign. But turning again to the employment market, there doesn't seem to be an upturn in layoffs. And of course, ultimately, it's jobs, employees, and spending that matters. So this is the big debate. Is the rise in the unemployment rate simply a function of more people entering the labour force and therefore increasing the denominator,
Yeah.
or is it an actual rise in layoffs? And this chart suggests it's not layoffs.
To be fair, if it normally layoffs only really start rising after a recession has started. So yeah, something to bear in mind.
So in summary, here are the reasons why there won't be a recession. Layoffs are low, consumer balance sheets remain strong, wage growth is still positive, total employment continues to grow, the nowcast forecasts all look pretty good, services PMI is positive, the credit impulse is turning upwards, the construction industry has been amazingly strong, and the rate cutting cycle appears to be starting. But why will there be a recession? Arguments against. The stock market has peaked, which is important in terms of the wealth effect and confidence. Unemployment is rising from a low level. The SARM rule has been triggered. Wage growth is slowing. The fiscal impulse, as opposed to the monetary impulse, is now negative, and manufacturing PMIs have turned negative.
Yeah. So just see how the data evolves. So far, the US economy has been remarkably resilient. And frankly, when you look through the data, jobs growth is slowing, but remains positive. The unemployment rate is rising, but, a chunk of that is due to just new entrants to the jobs market. It seems like the US market, the US economy is just slowing gradually rather than heading towards a recession.
Yep, yeah, as you said, a soft landing.
Yeah, soft landing. And on to good news. So, this is our own Royal Mint. And so they have created a facility where they crush old circuit boards and extract the gold. And the new facility in the UK can process up to 4,000 tons of old circuit boards a year and extract several hundred kilos of gold, apparently.
Oh, that's
And
fantastic.
yeah, rather than sell the gold, what they're doing is they're using it to back a green gold ETF in which 50% of the gold is recycled. And obviously recycled gold is much less energy intensive and environmentally friendlier than freshly mined gold.
Oh, that's fantastic. But look, the Royal Mint has done that, has it?
Yeah, absolutely.
It outsourced, it worked out the technology itself, did it? Phenomenal.
It must have invested in a company that, with the technology, but they've set up this plant in Wales.
Well, it's exactly the sort of thing we're going to need to recycle other precious metals and
Yes.
even base metals like copper, etc. I mean, if you
Well, I
could
was
put
thinking,
Tesla through some chewing up machine and recover
yeah.
all the metals, that would be fabulous.
Well, I hope they also recover the tin and stuff because those are also very valuable.
Wow.
So anyway, this is the share price of the ETF, ticker RMAU, which is listed in the UK and elsewhere in Europe. And if you're interested in investing in a green gold ETF, this is the one. And its share price does seem to track the gold price very well. On to equities, Stuart.
Well, as we've been highlighting a very volatile week, which you can see in this chart here of the All World Equity Index, the weekly change actually just minus 1.3% and year to date up 8.6%, but it was quite a ride.
Yeah, absolutely.
The UK FT all share, I think, less volatile than the rest of the world, given the lack of tech in the UK, down 1% for the year, up 6%, sorry, 1% for the week, 6%, up 6% for the year.
Yeah, really, it's largely ridden through it.
Yeah. Euro Stoxx 600 has taken more of a hit. I wonder whether that's perhaps some of the large drug companies in the European index, which perhaps have been sold off alongside the US tech. So down 2.5% for the week, up 4% for the year. S&P 500 down 1.5% on the week, but as we keep saying, quite a ride. Still up year to date 12%.
Yeah, yeah.
The Nasdaq, again, have a look at that chart to see the weekly volatility and the intraday moves, but down 2% for the week, still up 12% for the year. Russell 2000, what a jump that was, as there was a rapid move into and then out of small cap, and actually down 5% for the week and up only 1.7% for the year.
Yeah, really interesting. So the market is no longer convinced that actually US small caps will be big beneficiaries of cuts in interest rates. They think that it might be more than offset by slowdown in the economy.
Yeah.
So this is something to watch.
Hong Kong, the Hang Seng down 1% for the week, flat for the year. Topics, what an extraordinary chart. As Keith said, fell over 20% peak to trough and has retraced, what, about half of that now?
Yeah.
So on the week, down 5.5%, up for the year by 8%, but my goodness, that's quite a roller coaster. Bitcoin sold off alongside the tech sell-off, down 6% for the week, still up 40% for the year. On exchange rates, actually fairly quiet. The pound was up 0.5%. I think on expectations, the UK interest rates wouldn't fall as rapidly as previously expected. But I think the bigger picture is pretty flat the whole year. Euros to dollars are up 1.3% on the week, down 1% on the year. The dollar index has taken a bit of a kicking over the past couple of weeks, fallen beginning of July was at 106, now at 103.
Yeah. Mark is expecting US to start cutting rates.
VIX, well, I think we've covered this, that extraordinary spike, which on an intraday basis was even higher, up to over 60, now roughly around 20. Looking at some simple technical analysis, perhaps we should trust Simon on this more than these charts, but the Nasdaq has breached its 50-day moving average, which might be an indicator of a longer downturn. Nasdaq 100 liquidity indicator shows liquidity is extremely low in the futures market. So presumably that's a sensitivity to, well, prices could move very dramatically on any attempted mass sale.
Well, that's right. So, the moves this week happened during, the low, dull summer months when the liquidity is low, possibly exaggerating the moves.
Right, what have we got here? Some more. The stock market has an extraordinary run. Well, yes, I certainly know that to my cost. How much of it was animal spirits? How much of it was fundamentals? Well, here that's tried to be looked at in terms of a chart direction. I would look at that in terms of earnings versus PE ratios, for example. But on this technical analysis, it would suggest that the animal spirits were in the ascendant and the rate of increase was too strong.
Yeah.
A topping pattern takes months to develop. One of these charts where we overlay a current situation on a historic one. So this is Cisco, which was the darling of the internet boom because it was producing all the picks and shovels for that, overlaid with NVIDIA, which is producing the picks and shovels of the AI revolution. And that suggests a little bounce is coming for NVIDIA and then a long, painful period of readjustment. Always on these charts.
Yeah, exactly. Should be treated with the skepticism it deserves, but still, yeah.
in the scheme of things, the drawdown in the S&P 500 was pretty modest. I mean, 5% of drawdowns are pretty common. And so the chart here shows that 5% or worse has happened 94% of individual years, 10% or worse, 64% of years. 15% is not uncommon in itself, 40% of years. So
Yeah.
if you're investing in equities, know what you are buying. It's going to be volatile.
Yeah.
And these are the returns following 5% pullbacks, seemingly suggesting, is this a bounce back is very common after a 5% return?
Yeah. So because 5% drawdowns are common and the S&P 500 normally goes up, market normally bounces back.
Investor sentiment seemingly remains strong. I mean, presumably there's going to be an issue here, how often people
Yeah.
are surveyed compared to what the market is doing.
But the bounce back, suggests that actually people remain bullish
Yeah, buying the dip.
fundamentally.
Yeah.
They're buying the dip.
Investor positioning versus surveyed sentiment suggests that, well, actually, so far people have not altered their allocations, but
Yeah.
presumably is subject to how frequently the data is sampled. Valuations versus allocations. So in the blue line, we have households holding of equities as a percent of total financial assets, and comparing that to the famous Shiller-Cape ratio. So this I find interesting. I don't think it's people chasing the market higher necessarily. It's people holding their equities, those equities becoming more valuable and therefore becoming a larger percent of financial assets.
That's true. But when you look at investor positioning, the chart we've showed many times of the total assets held in equities, that's high. And that is the best predictor of future equity returns. Because when you buy equities, you have to buy it off somebody, and that drives the price up. So the forecast is, because that equity allocations are very high currently, that future returns in the next 10 years will be quite poor. Obviously, short term, it tells you nothing, but medium term, in order for the market to keep on rising strongly, you need people to keep on adding to already high allocations to equities.
Right. Here's a quick broadening of the Cape ratio analysis. This is from Barclays, and the blue line is the US Cape ratio. So this is basically Shiller's Cape ratio. And as we can see, that's pretty high. This is not news. Similarly, what is not news is the green line, which is the UK Cape ratio, which is very low, suggesting the UK is cheap. Obviously, the debate is it cheap for a good reason, i.e. lack of growth. But I wanted to show this chart because of the brown line. Now that's India.
Wow.
I was invested in some emerging markets funds, and India was a big part of that. And the India growth story is very, very strong. But you look at the performance of the Sensex index, I mean, it's almost a straight line that puts the Nasdaq to shame. It's done extremely well. The brown line here indicates that prices are getting very, very ahead of Indian earnings, suggesting there's a bit of a bubble in India. So that has gone from 20 times Cape ratio to 40 times, reflecting the India growth story, which is true, but it's a question of how much you want to pay for it. Now, these Cape ratios, that chart from Barclays' website, is fantastically useful. They appear to have taken it down, though. So if anyone knows where you can get good, free Cape ratios, that would be very useful. Please do comment, because I can't find it any longer, and I found it tremendously useful. Good news. Bonds did act as a hedge during the recent sell-off, apparently. Right, though only to a degree, I would have said.
Yes, I agree.
Yeah, it was partial, wasn't it? There was a definite fall in yields, but that reversed. I suppose it depends on what percentage exposures you've got, but I don't think a 50-50 portfolio would have been hedged during the sell-off.
Yeah.
58% of companies in the S&P 500 have reported their earnings, and growth is just 3% year on year. even though valuations have risen sharply. So this is back to the issue of the US market.
Yeah.
Can it justify its high P ratio? Yes, if the earnings growth comes through, but this is suggesting it ain't.
Yeah, absolutely. And margins we know are very high by historic standards.
Microsoft revenue growth here, still pretty strong.
Yeah,
Quarter on quarter, this is not bad at all, is it? But as we've been saying, that their capital expenditure, their cost line is also going to be going up much more than it has historically.
yeah.
Meta also decent revenue growth, weaker than it was, at 10 years ago, but still, 20% a year.
I know, amazing.
Amazon, this surprised me. I assumed that these numbers would be higher, but much more like 10%. But obviously, to
Mm,
some extent, Amazon decides its own revenue growth by deciding how much margin it wants to make.
yeah, I agree with that.
Apple, yeah, I mean, this is scary, isn't it? No surprise that Warren Buffett has sold half his stake in Apple because the valuation was very high and the growth didn't look particularly attractive at all.
Yeah,
So, over the past couple of years, minus 5% revenue growth, now plus 5%. So that they need a new product.
yeah, absolutely. I completely agree. But during this period, its valuation has absolutely shot up, even as
Yes, the
revenue
instant it
growth
said
has
it was going to
collapsed.
do some, what do they call it, Apple intelligence instead of artificial intelligence, that led to about 15% rise in the stock. I think Warren Buffett said, "Oh, that'll cover my CGT bill. I'm out."
Yeah,
Right. Well, how equities perform in the coming year will depend on whether or not there is a recession. Is that not a statement of the bleeding obvious?
it is. Yes. So, will the big question is the slowdown in US labor markets, does that presage a wider slowdown, or will the US economy achieve a soft landing and interest rate cuts lead to broader economic growth? Honestly, if I was to bet, I'd be betting on the soft landing currently. I just don't see the, it's been a very odd cycle. We've had labor hoarding, and in the case of the construction market in the US, which normally leads the market down, so job losses, higher interest rates cause unaffordability, leading to job losses, and that cascades through the economy. That just hasn't happened. It's been astonishing, the strength of the US construction market. And so unless that something changes, it really looks to me like the US has achieved a soft landing. So I, having had a huge bet, frankly, on recession and lost a lot of money, I need to reconsider where I am, and I'll be looking to take advantage of opportunities that arise in the next few months, basically.
But
Stuart,
presumably you
your
won't be
your
buying
thoughts?
equities.
Sorry.
Presumably, though, you will not be buying equities even if you believe in a soft landing.
Well, I will be, depending on what the valuation. I won't be buying US tech,
Mm.
but what we if we achieve a soft landing, then you're looking to buy, companies with a good valuation that will benefit from just broad economic growth. So I think tech is overvalued, and I don't play. We neither of us play that game. It's just like valuations are just ludicrous. Although, obviously SimonW, who's been playing Nvidia very well based on the technicals, has done it. Shown us how to do it. Basically, you don't necessarily need to believe in the fundamentals at all. You just need to, follow the what other investors are doing.
Yeah.
Well, that's not my game. I look at the macro economy, and at some stage, having made this big call, I need to, if the facts change, then I need to change my mind. And basically, the bottom line is I'm not seeing a recession. So I have, as you'll see when I go through my what I've done this week, I have cut some of my bond position to move into short dated gilts to provide me with cash to take advantage of opportunities. Thanks, Stuart. On to commodities. So interesting. Hedge funds have moved from long to short commodities. And actually, they're the shortest they've been in many years. Do they know something? Quick summary, energy markets were strong, particularly natural gas on both sides of the Atlantic. The Ukrainian invasion of Russia, I didn't expect to use that phrase, where they've captured the key gas transport link into Ukraine. I don't know why, but that has spooked markets about the possible disruption of Russian gas flows into Europe. And yes, there still are some. Industrial metals were mixed. Copper and iron were down. Nickel and tin were up. Precious metals generally strong, benefiting from market turmoil. So energy commodities, Brent roller coaster ride, but renewed tensions in the Middle East have been good for the oil price in the last few days, up 2% over the last 10 days, 6% year to date. WTI, even better, up 11% year to date. Numbers specific to the oil market, well, crude inventories continuing to build in the US. So US market oversupplied. And US crude production hitting a new all-time high of 13.4 million barrels a day, up 100,000 barrels on the year, and the EIA is forecasting it to keep growing in the second half of this year. Baker Hughes rig count up 3, but down 15 on the year. Now, this is the outlook for the oil market, and the outlook for oil obviously depends on the outlook for the global market. The black line is forecast demand from various different agencies, and the dashed line is supply. According to the EIA, markets will be weak. Oil market will be oversupplied in the coming year. OPEC think it's going to be undersupplied. IEA think it's going to be oversupplied. So watch this space. It's not an obvious bull market in oil currently. Natural gas futures in Europe surged and up 22% year to date. UK natural gas futures up 19% year to date. US natural gas futures bounced back a bit, but are still down 12% year to date. Coal having a good run, is now up on the year. Bad news for the world. Uranium drifting off, down 10% on the year. And onto industrial metals, Stuart.
Aluminium had been pretty weak through July, but has sort of stabilized around 2,300. Cobalt, another step down in this strange pattern that it's showing. I guess very illiquid. Copper. Now this is interesting, isn't it? Given what's going on or not happening in China in terms of construction. We all know the long-term story is very bullish for copper. But since June, it's been pretty weak, falling from $5 a pound to $4, a pretty substantial move, presumably based on weakness in Chinese physical demand. But it's obviously an interesting story long term for the energy transition.
Well, Dr. Copper is diagnosing a weak manufacturing economy in the world.
Chromium off about 2% for the week and about 5% for the year. Iron ore also weak, so somewhat backing up that copper story, off 6% for the week and down almost 30% for the year.
Yeah, absolutely. So this is a Chinese construction story, and again showing Chinese economy not doing great.
Lithium, my goodness, that's just been dribbling off for the full year. Yeah, down 20% year to date.
Yeah, and that is down about 75% from its highs. This terrible chart over the
Well,
course of the
it
18
does
months.
reinforce to me the difficulty of, a little knowledge being a dangerous thing again. What was it? Sort of 18 months ago, there was going to be a shortage of lithium and it was through the moon. So
Yeah, but I mean, as we discussed at the time, Stuart, it was because, we had just hadn't been looking for this stuff. And
mm,
then, the moment we go looking for it, we find loads of it. So as
yeah,
we were expecting it to, the bubble not to burst, but perhaps not as much as this. I mean, it really has been quite so spectacular.
yeah. Neodymium, I suppose over the past few months, fairly flat, really, though it's off 16% for the year. Nickel, yes. It seems to have reached, I shall pretend to be a chartist here. It seems to have reached some sort of bottom at around $16,000 a ton, which is the level it was at prior to a boomlet through the early parts of this year. Tin has bounced back quite a bit, up 5% on the week and 22% for the year. Zinc also bouncing a bit, 2% for the week, 2% for the year. And
Keep on
turning to
going.
precious metals,
Mhm.
gold, to some extent, I was surprised by this. It was up 4% on the week, which initially you would think, oh, that's normal at a time of crisis. But quite often, I think this is a point you've made in the past, Keith, that times of crisis, you sell what you can and
Yes.
what your risk model tells you you've got to. So
Yeah.
I wouldn't have been surprised if this was the other way around. But actually, in dollars, up 4% for the week, 20% for the year.
Amazing. Gold's having an amazing run.
Silver, by contrast, looking rather unhappy, up 4% for the week, but it's been coming off over the past couple of months.
Mm.
Platinum, sort of going nowhere, 0.5% change on the week and minus 4% for the year. Rhodium up 2% on the week, 7% for the year. Palladium also looking a bit unhappy, up 2% on the week, but down 25% for the year.
Okay, thanks, Stuart. On to rates. So good news is that UK yield curve is now down from it was a year ago. Last year, obviously, there was a terrible sell-off in August. But when you stand back, the 30 years, 4.5%, still very high. And so, we've now got a big premium for holding the 30-year relative to the 10-year. US yield curve looks much more normal, frankly, than the British one, with the rise in the 10-year to the 30-year only being like 20 basis points or so. And again, yield curve well down on last year, but most of that concentrated in short duration. I'm at long duration, and it's been very disappointing. The good news is that the long-term neutral rate expectations have fallen sharply in recent months, which suggests the Fed is gaining some credibility. This is the UK 2-year, sharp falls over the last couple of months, but the 10-year, not really, actually. So the market thinks that long-term UK interest rates are going to be much higher than they were pre-pandemic. This is the 30-year, even more disappointing, hardly moved, frankly. US 10-year, on the other hand, has come down sharply. German 10-year, come down sharply. French, also come down. Italian, that's looking really good, actually. So investors are encouraged by the strength of the Italian economy, despite the fact it's running a huge fiscal deficit. Greek, likewise. Concluding comments. Well, volatility is back, although the market in recent days appears to have recovered most of its poise. But volatility matters. Volatility feeds through to risk models and should mean that market participants have to cut their exposure to maintain a similar level of risk. So you would expect deleveraging. And just a lower confidence to mean that the market does not go back to its relentless grind higher. SimonW expects markets to have peaked in the near term from its technical analysis. But the market was also spooked by US non-farm payrolls, which were weak in July. 1 month's data is volatile and should not be extrapolated too far. The nowcast data shows the US economy continues to do just fine. And as we've dug through the data, it just seems to me the US economy, the jobs market is slowing, but there's just no signs of an imminent recession. Stuart, how are you doing this year?
Well, treading water, really. As I always highlight, there's a drip, drip, drip of income in my portfolio because I've got quite a few REITs and infrastructure stocks and green energy funds. So broadly speaking, most of my stocks have done nothing all year, but I've been picking up the income. So year to date, I'm up 3.6%. So trailing the all share, just about sort of keep my head above water. The big change I've made since I was on last is that this is talking about my SIP, is that I decided to take the 25% tax-free cash as a sort of protection against any actions by the Labour government to reduce and restrict that benefit. I've just put that into a gilts ladder because the money being outside of a SIP becomes taxable, whereas a safe non-taxed area is UK gilts, where the capital gains are tax-free. So I've just bought a little ladder of 1, 3, and 5 year gilts to park that cash. I did notice, by the way, that gilts yielding perhaps 4%, a bit under, premium bonds, they yield 4%, and that's tax-free too. Unfortunately, I noticed that after I bought my gilts and I didn't want to mess around, but
Yeah.
it is there. So in terms of action within the portfolio, has been pretty conservative in the sense that I'm buying linkers, but I am hoping that alongside Keith's exposure, that they'll actually do quite well when rates fall. I like the attraction of US linkers at the 2% real, and I like the duration of UK linkers. If rates fall, I'm hoping that they rally at the same time. I've also been adding a little bit to my gold position. I'm feeling a little nervous about US equities still, and which I think would cascade into equities generally. So I'm pretty conservatively positioned.
Yeah. On gold, I mean, my concern about gold is up 20% year to date. And medium term, your expectation is that gold will return in line with inflation. And I would prefer to buy a linker, which is in the case of tips, US tips, yielding inflation plus 2%. I mean, that's great. In fact, actually, Stuart, could you send me the which ones you bought?
Sure, will do.
I think I'm going to join you in that, actually, if I can't think of anything better to do, because as long as the problem with gold is that unless you buy Bank of England gold coins and bury them in your garden, then so you're going to have to pay capital gains on the tax. Now, because Bank of England gold coins are a monetary asset, you don't have to pay capital gains on the appreciation, but you have to pay them 1% a year to store it for you. So you could bury it in your garden or whatever, but seems a bit insecure. But if you buy an ETF, you have to pay 20%. So if you think about the long-term expected payoff, you're then going to get inflation minus 20%. Whereas you could get currently an index-linked gilt, which is going to pay you inflation plus 1% odd at the longer end. Over the course of the next 2 years, will pay you inflation plus 60 basis points. tax-free. That
Yeah.
seems right. So
Right. Yeah. Um,
uh,
this is the asset allocation that I have within my SIP, but I think more broadly, you're absolutely right that outside of a tax wrapper, yeah, you want to own the
yeah,
gilts. If you can get CGT free, inflation plus half 1%, that's a reasonable place to hide.
yeah, absolutely.
When I'm on Portfolio Matters, I often refer to some of the tax management that you can do via VCTs and EISs. Well, here's just a very brief update and a mea culpa. I think last time I was on, I was talking about the attractions of AIM listed stocks via a VCT.
Mm.
That hasn't gone so well. If you look at the left chart here, that's Hargreave Hale AIM VCT. I thought AIM stocks were cheap. I thought they had a bit of visibility, a bit of liquidity. I thought they'd gone up with the Nasdaq, they'd gone down with the Nasdaq, so I thought they might go up with the recent Nasdaq bounce. They've done all that except for the last part. They haven't gone up, they haven't rallied with the Nasdaq over the past year or so. So the chart here, which comes courtesy of Morningstar, shows that it's basically been flat over the long term, but quite a roller coaster with Hargreave Hale VCT, which focuses on AIM stocks. By contrast, private companies, unlisted companies, which I got exposure to via British Smaller Companies VCT, have done rather nicely, thank you. So in addition to the 30% of your income tax bill you get by investing in the VCT, it's actually performed pretty strongly
It
as
has.
well on top of that. So I had been suggesting and biasing my VCT exposure towards AIM. That has not worked.
And on to me. Well, I've survived the volatility and has upped slightly when the all share was down, but I'm still having a terrible year. I expected the rapid rise in interest rates combined with the very high levels of debt to lead to a recession in short order. And frankly, I've just been wrong. So when I look at the data and, Portfolio Matters is set up for me to examine the macro data each week and see how the world economy is doing. And then that is meant to, dictate my investment strategy. Now, over the course of the last year, I've made the call wrong, so the recession hasn't happened, but also equities have just been on an extraordinary tear, which seems completely unconnected to the strength of the economy, particularly in Europe, where the stocks has done okay, but the European economy is doing quite poorly. So now, what I've done this week, I'm going on holiday to Japan despite the earthquake warning, and I cut the position I put on in April, where I put on the 2058 gilt. And what I thought was an absolute bargain price, I sold it at still a bargain price, making 2.5%. Reminder, that includes inflation. So the price you see in the market is the clean price that excludes inflation. You get inflation when you sell it. So made 2.5%, tax free. No, but that's 10% annualized. Okay, that's good, all right. And I have bought in the meantime some TR26, which is the 2026 index in gilt, i.e. cash. So going on holiday last year, August was traumatic for me. As you can see, last year we had this terrible sell-off in long-dated gilts in August, September, October. And I've frankly didn't want to be thinking about it while I'm on holiday. And so I have cut my exposure and moved to cash. When I come back, I will be looking to put some capital to work. Now, hopefully, we'll have some volatility and allowing me to pick stuff up. Now, we have obviously had some volatility in the Japanese stock market over the last week. And if I'd taken advantage of that, actually, I could have done quite well, but I failed to take advantage of it. So going forward, I will be looking to take advantage of volatility. Now, the lesson from my previous big asset allocation moves is actually you shouldn't be too hasty if there has been a big change in the macroeconomy. So bear markets, when they play out, it's always tempting to buy when, they hit your price target and they've fallen a long way, and then they just keep on going. In the case of this bull market, as SimonW with his positions in Nvidia show, that, once trends get going, they keep on going for a relentless amount of time. They end up in places you never expected. So investing is hard, frankly, and going forward, I mean, where I've made my money, it's been by being reactive. So reacting to good prices. Where I've messed this one up is by being too predictive and thinking that I could forecast the way the economy and markets would go based on interest rates. And so far, it looks like I'm wrong. Now, that could change if the US slows down further, but I just don't see that in the data. Hence, cutting exposure and waiting for opportunities. Now, I need to be patient and not just put money to work because I want to make back losses. So watch this space. Any thoughts, Stuart? Concluding thoughts?
Well, it is the dilemma of every investor, isn't it? Do you hold on and be show perseverance, or is perseverance actually stubbornness?
Yeah.
It's an impossible position. I think it can help to write down what your philosophy is and to then measure current conditions against what you think you should be doing. Easier said than done. I've held on to very similar positions to you, but via different instruments, via my bond proxies like infrastructure trusts, and I've ridden the ride thinking that value was important when it's momentum that's been driving everything.
Yeah, absolutely. The thing is, I'm not worried about my big positions in T68 because I can hold them forever
Mm.
and they yield inflation plus. So that's great. Tax free. I think taxes are going to rise. CGT is going to rise. So the attractiveness of index-linked bonds could well improve in
Yeah.
the coming months. And medium term, I still believe that unless the UK has a big rise in productivity, then interest rates are going to have to come down. But,
Yes. Mm.
at some stage, I think real yields turn negative again. But, that could be, I don't know when that could be. And I can hold the index linked gilts in the background. And, when they're a good price, sell them. Now, right now, I think they're a very bad price. I think they're a very attractive price if you want to buy them. But, if you look at the long-term chart of T68, I mean, it peaked at 350 and it's now 65. You don't have to, once trends get going, you don't know how far they can go. And the reality is the trend has not got going. And when they start trending up, I may add to my position or whatever. But right now, it's there's no trend, is the fundamental truth over the last 6 months. They remain at astonishingly good value, despite the fact inflation's come down to 2%. So I've got capital. I hope there's volatility. Volatility produces opportunities, is where I am.
Well, I think you're wise to be holding the index links and not the nominal. I agree, real rates will probably need to be low, but I'm always nervous about UK inflation, and
Yeah.
holding a 4%, 30-year bond scares the hell out of me.
Yeah. Well, inflation, I fully expect inflation to come down, actually. And so far, I've been absolutely right. But uh, bonds have not responded. Real rates have not responded. And the reality is that because we have highly concentrated industries in the form of the NHS, then, when the government sets public sector pay at 5.5%, that means inflation is going to be sticky. And that means UK interest rates will be higher for longer. So, being in index-linked gilts, when they're yielding 4%, 4 point odd percent, compound that over 5 years, you have to grow your capital by 20% odd just to stay even.
Flat. Yeah.
And if you add CGT on top, you're talking 25%. So, indexing gilts, protecting yourself against inflation medium term is absolutely crucial. So I'm not that fussed about it, really. And I think that buying indexing gilts when yields are positive and there's a lot of economic uncertainty, and waiting for opportunities to come along, that's a good default position. And I'm not going to change from it unless I see good opportunities. And so, the viewers, this could be a really dull section as I stay in, index-linked gilts until something crashes, but that could well be what I do. Right. Okay. Thank you very much to Stuart Owen for filling in. And it's now summer holidays. I'm off to Japan. I hope I don't get crushed in the mega earthquake that they're forecasting. And next one will be in a couple of weeks when I get back. In the meantime, I hope you're having a good year and surviving these volatile markets. Please press like and subscribe to the channel. And it's goodbye from Stuart Owen.
And goodbye from Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.